What's up, everybody? This is Ahmed. And yeah, we all know that countries take on more debt to become better countries. Some countries take the debt for the infrastructure purposes, some countries have to take on more debt for the education purposes because the revenue of the country is not enough to fulfill its needs. So, countries have another measure which is take on debt from the external countries or from the domestic investors also. But yeah, we all know that it is a short term measure to become a better country because it kind of becomes a burden in future. We also know that it is a common pattern in the advanced economies and also in the emerging economies. We can literally think that emerging economies need that debt to become better countries, but when we think about the advanced economies, there's a question that comes in my mind that these are the economies that are already developed, so why they have to take on more debt? The reasoning of this question comes from the fact that the emerging economies are the ones that need more debt to build infrastructures, to build industries. And there's untapped growth for the investors, but still the debt to GDP ratios of the advanced economies are becoming sky high against the debt to GDP ratios of the emerging economies. You may think that it's risky to invest in the emerging economies, but let me tell you a fact that the advanced economies are the ones that are more scared now in the terms of foregone growth opportunities. High national debt affect every country at any given level, like putting on more taxes to service the debt, which undermines the investor confidence. But let me tell you that the advanced economies are facing one more additional risk, which is the risk of slower growth. The level of debt the advanced economies are reaching is actually diminishing the growth of these economies at a higher pace. Look, there are two kinds of growth in an economy. The first, the base level, is the growth from the infrastructure, the hospitals, and the education systems. These need to be built up to tap the traditional growth, which is also can be called as the standard growth. And the second level, which is the advanced level, which comes from the innovation. And innovation comes from the research and development. And when we talk about the advanced economies, they are already built up. The method they need to use to tap the economic growth is the advanced level, which is the innovation through research and development. And yeah, this kind of growth is practically more common in the advanced economies, the high income economies. The problem is that the process of innovation is immensely uncertain, as the research and development projects need high amounts of initial investment, and also it is the long-term effort game. And if the effort becomes lost, it is also kind of irreversible in the terms of the asset gain, because the research and development is kind of an intellectual property that cannot be sold like tangible asset at the scrap value at the end of the project if it becomes unsuccessful. So this property of the research and development keeps the governments away from investing in them when the government has to service high amounts of debt. At high levels of national debt, governments feel confident about investing into the short-term yielding measures like the standard activities, which is the base level of the economic growth. And that does not also yield the appropriate amount of the economic growth if we think about the advanced economies, because they are already developed. They don't need to build more infrastructure, but the government just spend that money into maintaining that infrastructure after servicing the immense amount of debt. So a government does not feel confident putting the money into innovation, which is the only left source of economic growth for an advanced economy. A paper issued by International Monetary Fund perfectly depicts this situation. It concluded that the growth rate of a machinery industry with a high reliance on research and development was 0.5 percentage points less than the machinery industry with less reliance on the research and development. When the data was compared between a country with a high level of national debt and a country with lower level of national debt. Not just this, when they extrapolated the results over a broad sample containing two-digit industry data, which is more granular, for our past 40 years, they saw a 2 percentage point per annum drop in the growth rate in the highly indebted countries. It is problematic when the average growth rate of the sample was just 2.9% per annum. Also, generally, this effect of high indebtedness of the advanced economies has decade-long effects on the economic growth. And the study concluded with proving that the low economic growth of the advanced economies is due to their higher national debt because of their reliance on the innovation-based economic engine. And the countries with more open financial systems like the United States have a little exception to this reality. Because if the government is not taking confidence into investing in the research and development and innovation-based projects, the research and development firms can source this investment from the private channels. But this exception does hold a little bit value in producing the economic growth in the highly indebted countries, because the investors of the research and development firms does not take risk into investing into the innovation because of the low confidence by the governments. If the government is not doing so they are not actually confident in doing so also, and they are more fearful of the additional taxes which the government can put on in the future in process of making the government revenues higher and higher to service the high levels of national debt. So what's the strategy can hold for this kind of environment? The investors can work towards the emerging economies. They can tap the growth which is more certain in these kind of environments, because the innovation based growth is uncertain and they need to actually check about that specific countries to do so. Traditional kind of growth is more kind of certain, and these kind of opportunities are more available in the emerging economies for investors. So this was all for today, and if you like this video, then don't forget to show some support by subscribing to this channel. And I'll also share this video with your family and friends, those who are interested into the finance and economic concepts. So bye.